All right, we're live. What's up, Andrew? How you doing this morning?
Doing well. Good morning, Richard.
So we're on episode 5, Money Mornings, our series talking about money, credit, debt, all the stuff that ties into it. Decided to pick the topic today on emergency funds. So what is an emergency fund and why is it important?
Is that a question for me?
It's a question for you while I drink my coffee.
Sure. Okay, so emergency fund, I guess its simple definition would be having an account of some sort in your possession that you can use if you have an emergency. Medical, financial, anything along those lines. If you're struggling with something and you need money, an emergency account is where you dip into when you need to get the cash to resolve something.
What percentage of people do you think have a set-aside fund for a rainy day? A rainy day fund, an emergency fund, whatever you call it. What do you think the ratio is of people that have access to that versus the people that don't?
I can only speak for those that I represent, because those are the people that I speak to about their finances. And with that being said, I think maybe less than 10% of the clients we have, maybe even less than 5%, would have a fund with a decent amount of money in it to rely upon in the event of a rainy day.
I just Googled an article here. It's widely accepted from financial experts that you should have 6 months of living expenses set aside, which is on average about $30,000 in Canada, in most large Canadian cities anyway. This Financial Post article from September 25th, 2017 is the most recent one. And it says only a quarter of Canadians have a rainy day fund. Quarter.
That would make sense. I was going to say probably no more than 20 to 40% of people in the country might have some kind of rainy day fund. But obviously our clients who are struggling, most of them do not. The vast majority of them do not.
So 75% of people are basically living paycheck to paycheck. They have no money set aside if something breaks, if their transmission explodes in their car, if there's a storm that blows through and rips their roof off and they don't have adequate insurance. I mean, most people have home insurance, so it's kind of silly, but you get the idea, right? I mean, usually when it rains, it pours, as the saying goes. So when bad shit happens, it usually happens pretty heavily. And not a lot of people are prepared for that, which tends to kind of like push them into that spiral of debt. And people that don't have access to money set aside will usually tap into their credit cards, right? Like we've seen people take cash advances, they'll go into overdraft, they'll borrow on lines of credit to try to solve that problem. Is that usually what we see?
Yeah, that's exactly what happens. You're going to use a credit facility of some sort, a credit card, a line of credit. Might go out and get a high-risk loan from a high-risk lender if they don't think that they qualify for a better rate from their financial institution, and they go and finance their new furnace or buy the furnace on credit. They repair their roof on credit. They replace their windows or doors on credit. They just
cash advances against
mostly
paycheck,
yeah,
right?
Yeah,
like payday loans.
Sometimes payday loans. Obviously, that's the least advised method of taking care of an emergency. Those rates on payday loans are extremely high. They're approaching the legal maximum at 59.99%, and that's ridiculously high. So a lot of people don't know that they could go out and get loans and money from other institutions at better rates than that, but they just think that's their last resort, and they go out and finance or apply for very high rates of interest from payday lenders.
The other thing that's not that transparent either is if you borrow cash against your credit card, you're paying interest daily, not at the end of the month when you get your statement, but they actually charge you daily interest when you do cash advances on credit cards, which most people don't know. And that can pile up pretty fast too.
Yeah.
We don't need to make this a full 1 hour session. We could probably cut this off in 5 minutes and cover everything we need to do.
Well, there's probably a lot that we can discuss on this topic itself. I don't think we're going to need the full hour, but one of the things I was going to bring up with you is, what's the major holdback as to why people don't have that emergency fund. So I was just going to go off and discuss how vehicles, the need for a updated, modern, keeping up with the Joneses vehicle is what is the major holdback for an individual not being able to start putting money aside for their future or for a rainy day fund.
Yeah, go. I like talking about cars, so let's hear your assessment on it.
Well, Obviously, we're not going to be talking about cars specifically here, which I know you would probably enjoy. But
well, the financial burden of cars is what we'll call it.
yeah, it's basically the financing of a vehicle. Now, obviously, financing of vehicles can vary in duration. You're talking anywhere between 2-year minimum lease agreements with some dealerships, and sometimes they go upwards of 8 years. So what I've seen commonly happen is people are financing vehicles of anywhere between 3 and 4 or 5 years, and then they trade them back in when that 3 to 5 year term is done. So they're consistently remitting a monthly payment to a dealership, or if it's not the dealership, the institution that they borrowed the money from, for a very lengthy period of time. And all they keep doing is upgrading their vehicle every 3 to 5 years. Now, personally, I don't agree with that position. I don't agree with that requirement. I drive a vehicle that's 10 years old, and I've got no problems with my vehicle. Now, that's not to say that that won't be for everyone's personal situation, but my vehicle is 10 years old, and I paid for it in cash when I bought it. And thankfully, I haven't had to make monthly payments to that vehicle, and will not be making monthly payments to a vehicle for any time in the near future, because my vehicle is pretty reliable. It's in good condition, and I take care of it. So what I've noticed with a lot of clients or a lot of people is they like to go and get the newest vehicle when they release a new model, and they trade in their previous vehicle with a monthly payment of anywhere between $300 to $700, and they continue in the cycle of financing their vehicle. That prevents them from building money up into some kind of investment or savings account, so they can use that if there's a rainy day. Like you said, financial advisors suggest that you have 6 months worth of living expenses. Well, if the average living expense for an individual is just say $4,000, 6 4s are $24,000. You need at least $24,000. It's very hard for someone to build $24,000 if you're paying anywhere between $300 and $700 per month regularly on a vehicle that you don't necessarily need to upgrade. Vehicles can easily last you 10 to 15 years if you've treated it well and you've maintained it.
I think there's a large misunderstanding from the general public where they don't regard used vehicles as reliable. And back when I was poor and young and didn't have a lot of things going on, or a pot to piss in or a window to throw it out of, I used to drive cars that I bought for under $1,000. I remember I bought a Chevette once for $500. Drove it for a year. I turned around and I sold it to, I can't remember who he was. He was somebody that ran a church or something, because he sent me a note afterwards saying that God thanked me for selling him the car. But I actually managed to get more money for it than what I bought it for a year later. I think it was only like a couple $100 more. But you can find reasonably, reliable vehicles for not a lot of money. I mean, $1,000 and under is probably a bit of a stretch nowadays. Probably under $2,500, maybe $3,000, you can find something that's in decent shape. It's not going to fall apart on you. And I had cars fall apart on me driving. Like, I remember I was driving to college once, and I was going down this hill down Warden, and they were scraping the surface of the road, and there was raised potholes, and I hit one. My wheel fell off. So that was a bit of a pain in the ass. But realistically, these older cars will get you from A to B. You don't have to go and buy something brand new to keep it with the Joneses and spend, like you said, $500 a month leasing or financing something, so you have a brand new, whatever version of something in your driveway, right?
Yeah, and that's one of the things that the car manufacturers do well to entice consumers.
Now, I have to get a new car, Andrew. It's got lane keep assist. It's safer for the baby.
That's the thing, is they keep redesigning the vehicles with new technology as well as newer designs that appeal to the consumer. So when they see that their new, let's just say Nissan Sentra has been redesigned with new upgrades, new design, and it looks a lot better, they've taken their 4 or 5 year Nissan Sentra in for a trade-in. And now they're continuing with a monthly payment that they don't necessarily need. The car that they currently have that is only 3 to 5 years old would be sufficient, and they would save that monthly payment in their bank account, or they can reinvest it in some kind of savings account, GIC, RRSP, whatever it happens to be, so that they have some kind of fund that is available to them if there is a family emergency, if one of the adults gets laid off, if one of their children has a medical emergency that requires them taking time off work or requires medical attention that they have to cover out of pocket. There's just so many things you can do with that money, and people just prefer to use the money on vehicles.
And you could save up 25 grand over 2 years at about $1,000 a month, right?
Well, yeah, but $1,000 a month is a pretty expensive car. There's not many cars that are being financed for $1,000 per month. Well,
I'm not suggesting cars specifically, but if people live well below their means, right? Like if their means are $5,000 a month and their expenses are $2,500, for example, they'll have a rainy day fund in no time, a lot faster than a couple of years. But ideally, like the thing that pushes people into the spiral is when you start getting into the high interest rate stuff, right? Like, let's be honest. I mean, if you're living paycheck to paycheck and you're paying everything that you need to on time, you don't have, any debt or much debt going on, to begin with. And let's say they cut back your hours at the Oshawa car plant where they're manufacturing the newest and greatest GM, whatever, or the utility companies, moving some stuff offshore to do something else, somewhere else, and they cut you back a little bit. All of a sudden, you've got a decline in your income, and then got your credit card balances piling up, and then you start taking the cash advances on, or you dip in your overdraft, or you dip in the line of credit, right? I mean, people that live well below their means, which is basically how we used to live for a long freaking time, right?
Yeah,
It's only in recent days that people live at their means because marketers and television ads and banner ads and bus ads and radio ads and TV, like all these ads keep telling people, buy this now. You need this latest and greatest shit.
Yeah, exactly. Right? You need this to be respected in society. And that's just one of the things that I've noticed. People are very happy to brag about the newest whatever that they've purchased, the newest furniture item, the newest TV, the newest iPhone or cell phone, the newest vehicle that they've just purchased. And all these things are purchased on finance, most of them. So it's not exactly an ideal situation to be in. It's just a matter of managing your budget in a better way. And personally, I was raised in a manner which I was always advised by my parents to put money aside. After you get paid, you put some money into an investment of some sort. The general rule of thumb is 10%. So if you're making $2,000 per month, you should be trying to save $200 per month of that. If you're making $5,000 per month, you should be trying to save $500 per month. If you put that money aside over time, it builds. And that's your emergency fund. That's what you rely on if you're laid off, if you go through a temporary medical situation, if you have a repair to a property that you might own. Obviously, if you don't own the property, you don't need to make the repair to it. That's the landlord's responsibility. But if you own that property, a new roof, new windows, landscaping, whatever happens to be, you need some cash flow. You need some money there.
What's that saying? People go work jobs that they hate to buy shit that, is supposed to impress other people that they don't even like. There's some lyric around that line, but it's, like it seems like to be par for the course for a lot of people. By the way, guys, I posted the join link for the Hangout. If you want to ask a question, it's in the chat. I don't know if it stays there, if it times out, so I'll just quickly copy and paste it in again. But if you want to ask a specific question about something to do with today's topic or even money or credit and debt in general, you can always click that and join us. You'll need to make sure you launch either from a Chrome browser because it's Google Hangouts, or if you're on an Android, it's native. I don't think iOS has it native right now, but you'll need to download the app for Google Hangouts, but should launch pretty easily for you there. You said that the amount should be about 10% a month?
Yeah, that's the general rule of thumb. That's what I was taught being brought up. That's what most people have been told. That's what you see perpetuated through society. Trying to save 10% is what you're trying to do on your salary.
Where's a good place to do that? Like where would you recommend that they set that aside? Because I know that we've got like these accounts like Tangerine where it'll automatically take a certain amount from your regular account monthly and then set it aside in your fund, right?
Well, it depends on how much money you've got. Again, most people want to diversify what they've got. So if you've got a good sum of money, you would want to put some cash flow into GIC, some cash flow into RRSP, some cash into TFSAs, maybe want to invest them into the market, real estate market, the stock market, whatever happens to be. But if you're talking a nominal amount, like if you're able to build a couple $1,000s and something like an automatic savings account through a high rate interest provider such as Tangerine or GQ Bank, I think it is, or EQ Bank.
Yeah, EQ Bank's got a really good rate right now. I think it's 2.4 or 2.5.
2.3, something like that. Yeah. So putting some money in something like that is not a bad idea. It's a starting point. And as the money builds, that's when you're going to want to start diversifying your portfolio and start putting it into different areas because the rate of return
definitely
might
want
be
to
greater.
put it in your TFSA. I mean, you can access it if you need to, but it's tax-free, right? I mean, like you're earning the interest and the holding there is a tax-free earnings vessel, right?
Yeah,
most people, I think the amount, it's around $80,000 or $90,000 is the maximum amount that you can have contributed to your TFSA. And most people are nowhere near that.
It's 63.5.
63,500?
63.5, yeah.
Are you sure about that? Because I was talking to Steve about that the other day, and I think he said it was something like $79,000 or $80,000.
No, I believe I just saw as well, and I spoke to Tangerine a few days ago about something, and they told me that it was supposed to be up to 63 or 63 and a half, something like that. I'm pretty sure it's 63 or 63 and a half.
We're going to ask the Googles of the world and find out what's the maximum TFSA lifetime right now, lifetime contribution. Oh, you're right, 63,500.
There you go.
Yeah, okay.
So it's still a pretty good sum of money. A lot of people have nowhere near that kind of money to invest, but if you do have $63,000 available to you, then that's a very good option for you to put the money into your tax-free savings account. Like you said, you don't get taxed on your return. So, and you can pull from it at any time without penalty. That's one of the benefits of that account. Unlike an RRSP, if you pull out of your RRSP, you're being taxed on that money immediately.
Correct.
On your tax-free savings account, you're not. So it is immediately accessible without penalty, and any returns you get, tax-free.
Let me ask you this. So RRSP, Registered Retirement Savings Plan in Canada, for those people watching from outside of the Canuck border right now. Some people pull from that when they have emergencies. Is it worthwhile to pull money from that to deal with debt or emergency issues that pop up? What do you think?
I think it is, if that's your only route. If you've got no other investments and all your funds, all your equity is built into an RRSP, then really yes, because most RRSPs might return you 5%, maybe if you're lucky, up to 10%. If your alternative is to pull money off a credit card or a line of credit, those rates on the APRs are higher. So if you're going to be charged 20% on your credit card, it doesn't make sense to pull money on a credit card and keep your money in your RRSP. So I would generally say, rather than taking money from credit with higher rates of interest, if your rate of return on your RRSP is smaller, which is usually around 5% or less, then I would suggest you take it off your RRSP. You are going to be hit on income tax. So if you're pulling, let's just say $10,000, you're probably going to have to lose about $2,000 to $3,000 of that in income tax. But if you've got no other option, that's really what you got to do.
Well, Shibby said in the comments, should you max out your pension? And I'm assuming by pension you mean your RSP contributions, and the answer to that is yes. If you have the ability to do so, you should always max out your savings contributions, especially if you get the tax credit. I'm sure it's like that pretty much everywhere in the world that has retirement saving structures, but definitely because it lowers your tax burden, it lowers your taxable income rate for sure.
Yeah, again, but I like to also add to that it's good to diversify your investments. So if you're entitled to put, hypothetically speaking, let's say you can put $10,000 into your RRSP on an annual basis, you might not want to put the full 10 grand in, because if you only have the ability to put 10,000 into investments, you might want to put 5 into your RRSP, a few $1,000s into your tax-free savings account, maybe $1,000 into a GIC. If you diversify it, you have the opportunity to pull money out from different investments if needed without having the penalties for it. So I still like to diversify if possible.
Cool. What else do we need to cover when it comes to emergency funds? I mean, you know what, dude, like at the end of the day, with our debt relief business, we wouldn't even have a business if people kept emergency funds, right?
That's true. If people had the ability to save money on the side and have their own emergency fund, they wouldn't be pulling on credit cards, and then they wouldn't be needing help to address those credit cards. But as we said earlier, the marketplace now is, banks are well placed to market their products. They want people in debt. People don't mind being in debt. They don't mind pulling from credit cards to pay for the newest furniture item that they require for the property, a repair to a property, for the financing of a new vehicle. They don't mind doing these things. And so if that's the mentality of the marketplace, then people will have debt. People will continue to require credit to sustain their lifestyle. That's just the way some people are going to be. Now, that's not my lifestyle. I try to live within my means, and that's the way I was raised. So I try not to finance the vehicle. I like to buy the used vehicle. I don't buy new vehicles. I buy resale vehicles that I believe are in reasonable shape, good shape, that will maintain for years. And that's what I've done with my most recent vehicle.
How do you spot a vehicle that's going to last you for a few years with limited problems? I know that you're more of a fan of, like, the cheaper domestics or the Japanese cars, right?
Yeah, well, that's what I was going to get to. Personally, my personal choice is dealing with Japanese cars. Japanese cars, in my opinion, have had a reputation of being more reliable, so I try to buy Japanese. Then I look for vehicles that have got no rust. I look for vehicles that have got low kilometers. Look for vehicles that have been owned by those that appear to have treated the vehicle well. So I look at their demeanor. I look at the property that they're living in to see how they maintain their property, how they maintain the vehicle. and it gives me a good insight of what the vehicle will be if I was to own it for a good 5 to 10 years. So those are things I look for. Everyone's different. People might not check the same type of equipment on the vehicle that I check. I look for electronical issues. I use the windows. I try the heating, the cooling. I pop the hood. I check the oil. I check the engine bay, see if it's been maintained well. Look at the tires. Look at the pressure on the tires. So I do a whole bunch of stuff when I look for vehicles. And if you do the right things, you can find the right deals. You can also see who's looking to flip a car quickly because they need the money, and those who are trying to sell a car because the car has a problem. So if you do your research, you can find a good deal, and that good deal will last you for a while.
Yeah, the answers to all of that are on the internet too. I mean, you can find articles or YouTube videos that explain exactly what to go through. What does this say over here? Got some comments here. Let me read them off. I was told by a few people that normal people can't afford to have an emergency fund with kids, health insurance, and mortgage payments. They are stretched to the limit. Well, you have to find a way to make it work. I mean, you don't live beyond your means. I don't know what normal people means. I think that normal people, by my assessment and definition, is people think that debt is normal. People think that living paycheck to paycheck is normal. You know, we live in a time right now where it's widely accepted that most people carry debt and they don't have the means to fix it should a problem arise. So I wouldn't call that normal. In actuality, it's more abnormal to live in that sense where you've extended yourself so far that you're always at the limit month to month to month. You know, you got to manage that shit. If you're having problems with health insurance and mortgage payments and kids and all the other obligations of life, then you have to either figure out a way to make more money, or you have to figure out a way to lower your cost of living. You can't live right to the limit. People push themselves to the limit because societal conditioning, because the media, because the banks and credit card companies are constantly encouraging people. We had a bank here. I'm not going to say which one it was, but it was, you know, they had like a marketing slogan, something along the lines of you've got more money than you think, right? Which really just encourages people to keep buying more shit and spending more stuff on things that they can't afford to impress people they don't even really like. So it's ignoring the, you know, societal conditioning that's encouraging people to live right up to the limit, which is what they want you to do, because they know at some point life is going to happen. They know that hours will get cut back. You might get in a car accident. You can't work. Something is going to happen that's going to push you over the limit. That's going to push you deep into paying high interest obligations that you can't really afford, that they've got you on the hook for. I mean, this is the stuff that our business fishes you guys out of, but they know that you'll get there at some point, just, you know, simply because if you're at your limit, something bad at some point is going to happen, which will force you to dig into high interest credit. So that's why they do that. You just have to be aware of, you know, societal conditioning that they're programming into that is not true. There's a lot of crap that we get fed into our eyes and ears, you know, in today's world that is not factually true, that we subscribe to. Like, you know, you drink the Kool-Aid, you get drunk on it, and then you're stuck on it. You're addicted to living at the limit for a period of time until you hit the wall. There's another comment here from Andy. He says, I was thinking of investing, but don't know how to. What should my first steps be? A possible topic for future investing for dummies. Maybe we'll cover that in another one. Anything else we need to cover on the emergency fund component? I mean, I would argue that you'd want at least 1 year of funds set aside, like living expenses, which I think would be minimum. 2 years would be ideal. For a lot of people, that's a big stretching. I'm like, you're living in la la land. You know, your head's in the clouds, Rich. You don't know what you're talking about. That's not achievable for many people. Well, I'll be honest, it wasn't achievable for me in my 20s, but I smartened the hell up and I figured out how to make it happen, right? You just have to make sure that you take ownership and take control of your life. Because if you're just going to, you know, like dead fish get pushed downstream sort of thing. And if that's how you're going to choose to live, then don't be surprised if something happens and you've got a shortage of monthly income and you're forced to dip into credit facilities that you can't afford to pay or take cash advances and things like that. Cash advances are a really bad idea, like Andrew covered early on, you know, like close to 60% interest. They also have these higher risk lenders which charge, what do those higher ones go for now? I think we talked about it in another show, like 35 to 59%.
Yeah, it ranges, but it can be as low as 35, but generally around the 40 to 45% to start, and it can go upwards of 59.99. The legal maximum in Canada for interest is 59.99. So there are a few lenders that go up to that maximum amount. It's sad, and a lot of people agree to those terms. And when I see those agreements, I think to myself, what have you gotten yourself into here? But a lot of people think that that's their last resort, is to go and get those $5,000 loans and paying back $15,000 because they need that $5,000. And it's because they don't have a rainy day fund. They don't have any money set aside in an investment of any sort to pull from if necessary. And we covered the reasons why, and one of the biggest things is keeping up with the Joneses, and how, you know, people need to have the nicest things and continue with car leases or car financing on an ongoing basis, and you just don't build up any ability to save money if you keep remitting a monthly payment, especially a large monthly payment on a car. Like, that's probably one of your biggest expenses other than housing. So if you're going to pay $500 to $1,000 on a car every month for 5 years plus, that's a problem. That's what's prohibiting you from building up your investment.
Yeah, there's so many different areas that people can fix that in. So to actually, like, say, like, where do I start? Well, you start by spelling out your budget. You start by, what is my income? What are my expenses? What are my debt obligations monthly? And then you figure out what kind of cash flow you have. And you should have money left over, which should be going into your rainy day fund. And you should be doing that on a consistent basis so that you've got access to money for a rainy day, for an accident, for a surprise, for an emergency, whatever that might look like. Some people create these rainy day funds to take vacations, so they can scrape together like $1,500 to go down to Cuba for a week, so, you know, sort of thing. But if you deplete the rainy day fund, you know, it's got $1,500 and you're not building it up to like 6 months worth of living expenses, then that's on you. I mean, there's any number of ways to change your cash flow scenario. Lower your cost of living, make more money. If you have, you know, a house with a spare room, list it on Airbnb and rent it out. Take on a roommate. You know, there's any number of things that you can do. But if you're writing out your income and expenses and your assets and liabilities, and you see that you don't have any cash flow, you're going to have to start cutting some fat. You know, you're going to have to start cutting some fat out of the budget that you don't necessarily need. Most people don't need cable. I don't know why people have cable today. Honestly, like, that's one area that somebody could save a shit ton of money. I haven't had cable in 10 years. Honestly, I have not had cable. You come over to my place, Andrew, you're like, nice place. I can't watch sports, man. I'm like, yeah, because I don't watch cable. You know, I know that you like to watch cable. I'm not a cable guy. I don't feel like paying to watch programming. Plus, while I'm paying to watch programming, have commercials shown to me the entire time that I'm watching programming. You watch a hour-long show, you get like 25 minutes worth of commercials. I got no time for that. Plus, most of the stuff on TV is garbage anyway. I'd rather watch documentaries. There's a lot of great content on YouTube. You can watch good movies on Netflix for, I don't know, they keep upping the price, but 12, 15, you know, bucks a month for their program, depending on the bandwidth that you take up. But there's so many places that you can cut your expenses, which will allow you to start. And even if you start somewhere at $25 a month, $250 a month, whatever it is, you know, you multiply that until you've got something set aside. And it feels good to know that you've got that, right? It feels good to know that you've got a crutch that you can lean back on in case something happens, which most people don't have. Yeah, really, a lot of people don't have that.
That's a good topic. I was going to say that it's a good point. Starting point is going over your budget, looking at your income, looking at your expenses, seeing which fat you can cut out, and see how much money you can save from cutting out that. Now, another thing that I've noticed, some people don't think that they need to have an emergency fund if you own property. They think that if there is ever an emergency, they can tap into the equity in their property. Now, that is a possibility. It all depends on the market. It all depends on the valuation of your property. It depends where you live. There's quite a few factors involved with that. It also depends on your credit score. So there's a few factors involved. And I don't think it's wise for people just to assume that if there's some kind of emergency, they can just tap into the property. They can, you know, arrange new financing, a second mortgage, refinance a brand new first mortgage, or even sell the property. There's all the different types of scenarios. Real estate fees eat into that equity. The market fluctuation can eat into that equity. Real estate legal fees will eat into the equity. So there's a lot of things. Mortgage penalties will eat into the equity. So there's a lot of things that you need to take in consideration if you're going to rely on the property.
There's also guys that do these equity takeouts for debt consolidation mortgages that are like sharks. And I've seen the mortgage commitment statements of what these guys do, and they can be pushing into the 40 to 50% mark for the total cost of borrowing, with lender fee, interest rates, like all the appraisal costs, the legal fees, everything that gets piled into the total cost of borrowing on the mortgage commitment. If you're higher risk with a high loan to value and you've got crap credit and you can't go to a bank or even like a B lender, like a home trust or something like that, you could be paying huge interest rates. I mean, like a lot of people go, well, you know, it's interest only 14.99% sort of thing. It's lower than my credit card at 28%. But once you pile on the lender fee, the appraisal costs, like all that stuff, it can pile up and it can become quite expensive, even though your monthly obligation might only be 14.99%. You know, when I say only, but you know, like the cost may not be that cheap. So you're right. You know, trying to rely on property to, you know, be your savior if you have debt. It's not always guaranteed. I mean, there's a lot of times that we have customers that come in that look like they have equity, and we see creditors that'll come and ask going like, well, why can't they get a mortgage to pay that off? Like, why can't they borrow against the house to pay off the debt? It's like, they've tried. Nobody's going to lend them money on that equity. It's like where they live and the loan to value based on the state of the property and disrepair, nobody's going to lend on it.
Right. Yeah, we see that a lot.
Yeah. I don't know what IPTV is. Somebody said get IPTV or watch YouTube. We know what YouTube is, but what's IPTV? You ever heard of that, Andrew?
No, I haven't. But IP is obviously a computer term for IP addresses, so it's maybe some kind of TV you watch on your computer.
Probably. There you go. All right. I'm good to wrap up now. If you're good to wrap up, I think we covered everything. We don't need to, you know, drag it out and beat it up a little bit more. What do you think?
Yeah, that's fine.
All right, so we'll come back on next Saturday. I've been horrible at promoting these events. I really need to create the event earlier and promote it. I only created this like 45 minutes before we started. But we'll keep doing these, and we'll see you guys next Saturday morning, 9 a.m., and catch up with you again. Thanks for joining me, Andrew.
Thank you. Take care, guys.
All right, see you guys later. Ciao.